Meantime, short-term Treasury bonds continue to be a hot trade, not just for Buffett or Ackman. The 10-year at a 2-week high. B of A saying clients are now buying T-bills at the fastest clip in over 3 months. U.S. Treasury's on track to hit a record $206 billion in inflows just this year. That's a great chart from Hartnett today. Bianco Research President Jim Bianco joins us as well. Jim, curious to know your thoughts about why those inflows are not affecting yields the way some expect.
Well, because the Fed, a lot of those inflows are coming on the short end of the yield curve. And that's because the Fed has been holding rates up. And while we've discussed that maybe they'll cut rates in 24, they're not doing it now. And I think, the TINA trade is over. There is an alternative. The alternative is 5.5% yields on T-bills or 5.25% yields on money market funds. That's the long-term average of the stock market is supposed to be about 9%, according to the University of Chicago. Yeah, I could get 2/3 of that now with zero risk in a money market fund. So for a lot of people, it's attractive. It's not 2019 when if you wanted to stay out of the market, you got nothing. You're now getting 2/3 of the returns you would expect over a long period of time.
One of the characteristics, Jim, of the last few weeks has been this march higher in yields, despite what everyone thinks, which is the Fed is either done or nearing the end point of the rate hiking cycle. So what do you think happens with yields from here?
Well, I think that the march higher in yields is because people think the Fed is done with the rate hiking cycle. We've had a steepening of the yield curve, fancy term for meaning long-term interest rates, 10 and 30-year rates, are rising faster than short-term rates. I think there's a fear in the market that there's going to be some reacceleration of inflation, not to 9 or 8, but maybe back towards 3.5 or 4. And if the Fed's not going to fight that, I don't want to own your 10-year notes. And that's what you've been seeing in this market. So ironically, if the Fed's going to be done raising rates in this type of environment, the result might be new highs in yields because there is a confidence that the market doesn't have about inflation. So if the Fed wants to stop, we might actually see longer-term rates and mortgage rates and other rates like that go up, unless the market is completely convinced that the inflation story is behind us. And I don't think it is. And that's why you're seeing the yield curve steepen.
Well, that's why UMich was so interesting today. And some of the long-term expectations are not following the trajectory of at least headline CPI, right? That's a little worrisome.
Yeah, except I'm going to push back on UMich. I've not been a big fan of surveys. The UMich long-term survey was a 2.9, down from 3 today. But it's been between 2.9 and 3.1 for the last 2 years. And in the last 2 years, we've had some wild inflation numbers, a 40-year high, a move from 9 to 3, and that survey never, ever moves. So I really question what it's really telling us, because if a 40-year high and then a 9% to 3% move in year-over-year inflation doesn't move that survey, I don't know what will at this point, and I don't know how useful it is, to be very frank about it.
So what you just said was the polar opposite of everything that Tom Lee just said, who was on just before you, who likes stocks because he does see this disinflation as real, and the Fed stopping raising rates, and that mortgage rates and other rates should come down. So does this mean that you're bearish?
Well, on bonds, yes. I do think that yields will continue to go higher from here. On stocks, you've got two options, the way I want to put it simply. Option one is we go into some kind of recession or some kind of softish landing that may be a little bit softer than people like. And then we have to contend with, declining economic performance, and maybe we have to decline with struggling earnings. Option two is the camp I'm in, which is probably more aligned with Tom, is the no landing camp. We just keep going. There is no recession, but that keeps demand on interest, that keeps demand on inflation, pushes prices, keeps interest rates up. Now, given those two options, I think the stock market's better off with the higher inflation, the higher interest rate scenario than the potential of a recession right now. Yeah, is it a headwind for the stock market? Sure, but it's not as big a headwind as the other story, which is in 6 months we would have a recession. That, I think, is a bigger headwind.
Really quickly, Jim, we're all focused on the auctions, given the fact that the government has to issue so much debt. Any big concern from you from what happened with the 30-year demand picture yesterday and just going forward, what these are going to look like?
People put too much emphasis on these auctions. The day before, the 10-year was great. Then yesterday, the 30-year wasn't that great. Auctions have a shelf life of about 24 hours in affecting markets. We're already past that. We're on to other things. I think we way overstate the importance of auctions on the longer-term, bigger picture outlook on interest rates.
I guess that's a no then.
Yeah. Maybe next time we'll talk some corporate debt as well, Jim. That's getting interesting as well, too. Good to see you, Jim Bianco.
Thank you.
Coming up, the Dean of